Kate Rogers laid out a great kind of primer, if you will, on what's happening with certain parts of that restaurant scene. Do you feel as though this is one that investors can still be comfortable with?
Yeah. Morning, Dom. Thanks for having me. I do think that things are getting better at the industry level, right? I think we'll have seen a better exit rate for the third quarter than we started. So that makes me modestly more optimistic. But, to your point, there's still a lot of bifurcation here, right? Fast food is still kind of fighting the value wars. I think you're still seeing some of the fast casual stuff, higher end exposed, still doing quite well at this point.
Do we feel as though, Brian, that these value wars are going to have an impact on these companies and their profit margins? Is this going to be a race to the bottom, so to speak, to try to get consumers in the door, given the spending patterns that we're going to see into the coming year?
I think it'll be very competitive, right? To be honest, I think that McDonald's, notwithstanding sort of the current issues that we just discussed, actually comes out of it quite well. I do think that they're able to sort of regain an advantage. No doubt they got offsides on price, but I feel generally quite good about McDonald's into next year, and so that's why we still like that one. But this isn't going to go away quickly, and to some extent, this is sort of just a return to normal promotions, I think, in the fast food landscape.
Brian, from a fundamental standpoint, where do you think the value is, so to speak? Is it going to be in some of those fast casual names, or do we feel like we want to go up the spectrum, mid-scale to even high end?
Well, like I said, I do think that sort of McDonald's is sort of reasserting its value advantage. I think the Domino's still offers very good value, still driving traffic growth. They've already reported, but we like that stock into next year. Look, I think that from an absolute price point perspective, Chipotle still ranks very well within the fast casual landscape. And I think that versus, for example, a Cava or a Sweetgreen, I think their price point still offers good value for what is certainly perceived to be higher quality, and they still set up quite well too.
Katie, I wonder if I could bring you in for a look at the charts. We've seen some real downdrafts and some real negative feeling, if you will, in the charts with regard to companies like McDonald's and Starbucks. Meanwhile, Cava and Sweetgreen on the premium side have done extraordinarily well. How do the charts set up in your mind, and where do you think the best plays are?
Well, it's unfortunate, of course, with McDonald's. The chart now has a gap down, and it affirms this overbought sell signal and does suggest that McDonald's in the near term will remain out of favor. With that, I'm a little bit more interested in the counter trend setups in the restaurant space. So I would draw you to Wendy's and also Jack in the Box as two that stand out. Jack in the Box in particular has some signs of downside exhaustion per the DeMark indicators, suggesting that perhaps it will see a relief rally, much like we've already seen from Wendy's. And then Wendy's has some inklings of a long-term turnaround on the chart that I'm compelled by. So I prefer those turnarounds as opposed to the ones that have already had nice runs, because I think especially if we do see a correction in the broader market, that the investors are more likely to penalize those that have run up.